Amazing insight into one project. Now here is Zack Guzman of Yahoo Finance to explore crypto lending and credit with Celsius's very own Alex Mashinsky, Abra's Ben Liams, and StableTech's Kevin Mehrabi.
Welcome in, everybody. Thanks for joining our panel here at LA Blockchain Summit. We've got a very interesting and spicy panel, perhaps the spiciest title at the whole summit here, How Crypto Lending and Credit Aim to Kill Banks. And it's we're going to hope we can deliver on the spice here, but very happy to be moderating this one. Happy to see that I was chosen for this one. We've got a great panel here to discuss that very question, how crypto will be killing banks. I'll introduce myself first here. I'm Zack Guzman, the host of Crypto Corner on Yahoo Finance, the most trafficked business site out there, focusing in on crypto questions, including this one. And with me along for the ride here, we have Alex Mashinsky from Celsius Network. Obviously one of those large centralized networks here helping people access crypto, alongside Kevin Mehrabi building out things there at Tezos, and Ben Liams from Abra as well. I'll let them introduce themselves here real quickly, guys. If you want to go around for 30 seconds or so to keep it short, it's less exciting to see only one head on a screen of four heads talking. Alex, why don't you introduce yourself real quick to the crowd and let them know what Celsius does.
Sure. Thanks, Zach. So Celsius is a membership organization. We have about 1.2 million users worldwide, manage about $25 billion. And we just crossed $1 billion in yield. We paid out $1 billion to our community. And that's really the big difference between companies on the blockchain and your traditional banks, right? They stop paying you and they make us look real good, you know? So we also issue loans. So if you need a margin loan against your assets, you can basically put your assets on Celsius and take a loan, and basically 1% loan from Celsius.
Cool. Nice, short and sweet. Kevin, why don't you go next?
Yeah, my name is Kevin Mehrabi. I build stuff on the Tezos blockchain in the DeFi space. So DeFi on Tezos, it's nascent compared to Ethereum or other more mature DeFi networks. In fact, Tezos is still incomplete in that it's not DeFi cycle complete without not having a lending system. But that's one of the things we're developing, and it's coming out in the next few weeks. And that'll be TezFin, Tezos.finance. So, you know, a lot of parallels there in the lending world, stuff happening in Tezos. Also, we developed StableTech, which is the company that does all of this stuff or coordinates it in the decentralized fashion that it is. It's very hard to describe DeFi entities because they're so decentralized, you know, a lot of distribution. But yeah, so StableTech, it coordinates the development and for TezFin, Tezos.finance, TezX, Tezos Exchange, that's tezx.io, and also stable Tez tokens, which are stablecoins on Tezos, built at Tezos FA token contracts. So with that, we have USD Tez, which is the first stablecoin on Tezos. It is fiat-backed, fully convertible, KYC, AML compliance, and making sure that for minting and redemptions, and also making sure that people have a good experience and they're using a good contract, and really aligning ourselves properly with the ethos of Tezos. And alongside that, ETH Tez and BTC Tez. So yeah, it's kind of that full stack of that DeFi cycle. That's the stuff I deal with. But yeah, it's a really exciting time because Tezos is so new in DeFi, and we get to kind of like watch this sprout come out of the ground before it gets to the points of billions of dollars. And we're tens of billions, you know, or the hundreds of billions where Ethereum was at this point. We're at like 100 million total TVL at this point. So you can see the comparison there. We have yet to scale. But with that, I think I'm getting long-winded here. So let me pass that over to Ben Liams.
Yeah.
Much more interesting things, I think.
Good stuff, Kevin. So I'm Ben. I head up credit and trading at Abra. I think we're best known as a crypto investing app. We make it really easy to buy, sell, store, earn interest on top cryptocurrencies. We've been around since 2015. I think we've established a reputation for being trusted, easy to use. We're available anywhere in the world. You can deposit by credit card, bank, or wire transfer. Yeah, in some countries, we even support cash in through retail. If you go to abra.com, you can find out more about us.
All right, well, let's jump into the main topic du jour here. As we were talking, it's not an overnight quick murder of banks. It's a slow burn, a slow murder, if you will. And it's taken some time. And of course, there are kind of questions, I suppose, that we're going to get into here when it comes to regulations. But I guess I want to start on the idea of killing banks necessarily, if that's what it even is, right? Because maybe we've drawn people into the discussion with the idea of killing banks. But as you just kind of laid out there, Ben, I mean, the interaction with people on-ramping into crypto does require some sort of on-ramp, I suppose, through banks for people to first get started, maybe. And so I guess we'll start with a question there. I mean, Alex, you and I have talked about this too many times, whether or not it would take kind of killing banks to see crypto achieve the promised land in terms of what it's trying to deliver on here. But how do you look at the relationship between banks and crypto as it gets built out?
Well, look, I think Bitcoin definitely has proven itself as the best store of value. It's the best performing asset class in the last 13 years of its existence. But traditional fiat currencies are still kings as form of payment. Bitcoin is a horrible form of payment. So each one has its own purpose. And like you said, most of the money in the world is still in the fiat domain, in the TradFi or traditional finance domain. And currently we only have two basic applications, right? Store value and yield, so which you can't really get from the banking system. So I think the longer banks continue to not provide store value solution, not provide yield, the faster they will be essentially go out of business. So it's going to take some time for Bitcoin or Ethereum or some other solution to become dominant enough to start provide the form of payment solution as well. And at that point, there's just not going to be any use case for traditional banks.
And
yeah, I would think of it. I think it was Billy Eichner. He said traditional TV isn't dead; it has about 3 to 5 years to live. It's a kind of transition where it's not like anything goes away or gets. I think the spiciness of the title is because of how morbid it sounds. The panel, the death. It's like, oh my God, it's going to be a slaughter. No, probably it'll be mild. I think there'll be a way to participate that's a bit different from the traditional methods that have been done before. But let's remember that traditional banks are very, very, very good at catching up with technology. They were the first to institute, the telegram in a data-driven fashion using tickers. And by the 1880s, there were thousands of stock tickers in offices all across Manhattan. 1880s, we think of this, it's like a mini fax machine. That's incredible. Finance picked up on that, right? What else did finance do? Finance picked up on, telephones. There was a time when it was like, oh, you can't do your banking over the telephone. Are you nuts? That's crazy. Okay, yeah, whatever. Maybe in your comic books or whatever, kid. But yeah, of course, that's a thing that can be done. There's an authentication there. And then in the 1950s, you had Bank of America pick up on digitizing computer records. That was before any industry, or you had them in universities for research. I mean, it was a very early time for computers and storing data digitally. And so, modern day, what do we now? We look back on, Ray Dalio's book, and all that stuff, just picking up on facts and everything else. So traditional money is money, and money will do whatever it can to survive, even if that just means, and quite often is, going with the flow of technology transformation. And getting swallowed up is, that's a life cycle. That's what it is. That's how technology disrupts. So, but I think money will be fine. It's just going to transform.
Yeah, I guess that's another good point too when we talk about where DeFi is versus I guess some of these more centralized crypto lending platforms or platforms that help people kind of get on-ramped into crypto. And Ben, at Abra, I wonder kind of what you see in terms of how that dynamic works versus how quickly someone might get comfortable. There was a lot of talk about people maybe not ever using MetaMask. The masses couldn't understand how it works or how to use it. It's just going to be this fringe people who are into Bitcoin, then get into Ethereum, then get into the rest of DeFi. But I mean, it seems like that's changed pretty quickly over the last year as interest has grown. I think it's kind of like a third animal spirit that people didn't build in their models. But I guess, how true is that in your eyes? What do you see as kind of that dynamic?
I think two dynamics that I point to. First, from kind of the market opportunity of course, right, it seems like this burgeoning interest in DeFi has really accelerated in the past year and a half. And I think we see that even inside of Abra. Of course, ours is a centralized platform. It's an app that's meant to make crypto easy to use. But we hear a lot of interest from our own users. I think from the user's perspective I think that's really where you start to see a lot of challenges. I think, kind of learning how to use MetaMask in the first place, I think is enough of a point of challenge that, I think the obstacle that it poses for people who have expectations to just sort of click and be able to deposit into cryptocurrency is something where there's a gap in the UX. And I think probably not just in this room, but in a lot of the cryptocurrency app space, I think there's a lot of innovation coming on that front. I'll just leave you with one factoid on this particular question. Abra initially started and launched out in Asia. So it's maybe a little known fact. It's been now 6 years. And I want to say in a place like the Philippines, where you might not necessarily consider sort of the leading edge of banking and fintech innovation, we're hearing a tremendous amount of growth for people who are learning through these play-to-earn systems and other incentives to be able to use the DeFi tools that are available out there now. So I think somewhere between sort of this burgeoning opportunity and people, having the will to learn how to use these tools, I think there's a tremendous possibility that we're going to find an order of magnitude more growth once the tools become easier to use.
Yeah, and I guess that's one piece. Alex, you've mentioned this. I think your shirts, the Celsius shirts, always say "unbank yourself." Among other spicy things out there, there's spicier things than "unbank yourself." That's not even that spicy. But you talked about fees when it comes to that, and I guess that's kind of one of the main things that you don't really even need to understand DeFi to really access here when you're talking about people who are using banks. It's just the fees that add up in all of this too. I mean, how big of a draw is that in getting people onboarded who don't really maybe want to come to crypto and explaining how it all works?
Yeah, so definitely, I think at least 90, maybe even 95% of the population is not capable of farming on DeFi pools, right? I mean, they're just not going to know even where to start. They don't know what's the difference between a private key and a public key. And especially if they're migrating from traditional finance, it looks completely weird and crazy to them, right? So part of what Celsius does, it basically you don't have to know anything, you don't have to do anything, right? You just put in assets that you have, if it's Bitcoin or Ethereum or stable coins, and they just automatically earn yield every week. Every Monday you get paid out, and frankly, what you have paid out, you will never be able to replicate yourself running around on all these different pools, because the gas fees and other fees, withdrawal fees, are all going to eat away at your profit. So unless you're a trading maven and you got millions of dollars to move around, you're not going to be able to compete with somebody like Celsius, who's deploying billions of dollars on DeFi, right? So I think the main difference between traditional markets and what Celsius does is that in our markets, the velocity of money, the velocity of dollars is 20 times higher than what the Fed effectively transacts with the banks, which is 1.2. You can go to the Fed.gov database and look at the velocity of the US dollar, 1.2, down from 2.9 in 1990. So that decrease in velocity tells you that our economy is slowing down, and all the GDP we're producing is financial engineering, right? So here is a market in which the dollar turns 20 times a day instead of 1.2 times a day. And that's really, because of that, it can earn 8.8% on the stablecoin, right? That's really the main reason for that much, much higher yield. So most people, who trying to pay their credit cards or finish the month, are looking at that and saying, I'm not going to keep my dollars in the bank. I'm going to buy a stable coin. I'm going to put it in Celsius. I'm going to get up to 100 times more than what my bank pays me, and there's no fees. So it's a very easy decision. And like I said before, the banks that make us look great. The other spicy T-shirt we have is "Banks are not your friends." You know, so if that deliver the message better, I'll go and change. I'll put that one on.
No, Kevin, I think that that's a good point when we're talking about DeFi and everything else. I guess, you know, to further the murder metaphor here, if we're talking killing banks, you know, fees and the ability to make money obviously makes this death of banks easier. But when we're talking about maybe prices going down, it becomes maybe a little bit harder to see. Of course, we've been in quite a bit of a bull run here. But when it comes to maybe how people are interacting with DeFi platforms and the expectations of returns, and I guess, you know, weighing in risk to all of this too, there have obviously been hacks on some DeFi platforms. I mean, how do you maybe see some of those things turning if prices do go down, whether or not the growth that we've seen can continue?
Yeah, I think a lot of those things are, you know, they're just part of the growing pains. You know, that's just what happens. I think for the most part, the disruption has been pretty good, pretty strong. And what we are talking about, and to also build off of what Alex was talking about as well, is that like this is a reconstruction. You know, we're starting to see this money move into a different direction because it's more capable, because you could do more things, because you have more ability to engage in strategy. And with that, there are new products and services, and those are interesting as well. So it's a continually growing field. It'll have its ups and downs, but some adaptations occur. I mean, a few years ago, if you were even like a year ago talking about DeFi, you were just talking about Ethereum and its high gas fees, and there was nothing you could do about it. But now there's movement in other directions. Just like for the most dominant use case of blockchain today outside of DeFi, which are NFTs, in different forms and different ways and different reasons and different types. Sure, there are many layered products and services there, but it's huge. And where did it move? Tezos, because of the low gas fees, among other things. You know, and the more like the long-term expectation of longevity. So amongst the most popular NFT marketplaces and used smart contracts are Object.com, Nunk, Calamint. You know, people didn't kind of see this coming, but it just kind of happened this year. Whereas a year ago, also, we weren't really talking. A lot of people now are saying, oh, Tezos is just all about the dApps that are on it. Whereas a year ago, they were saying, oh, yeah, Tezos maybe has the superior technology, but they don't have the dApps. You know, so I think, you know, and, you know, obviously I'm an enthusiast of a certain blockchain, but I think it's just showing that the industry as a whole is shuffling around. And the market is very small. There are less than 1 million users per day on Ethereum. You know, and still, you know, the most dominant influential force. So, I mean, how big of a market are we really talking about here? It's very, very small. So we're still deciding, we're still learning, but to mark this progress of all of this money, hundreds of billions of dollars now in the DeFi world, that's huge. Whereas it wasn't even 1% of that a year ago. So, I mean, this is a very a new time that I think we're still building a language to understand and to talk about, because it's just, this is the earliest part of that curve. But yeah, so, and that's why we've been seeing a lot of people come, you know, one thing about the gas fees, but there are people who come to Tezos and then they convert from ETH to ETH Tez, and then their stablecoin to USD Tez. And then they trade those back and forth. Okay, they're very interested in Ethereum and the spot trading and the high frequency trading, but they're not going to do it in a decentralized way if they're going to have to be hit with the gas fees. So DeFi does survive. It moves just to the place that it makes more sense, where the critical path is, where you know, the least number of switches are occurring. You know, that I think it's, you know, for our picture, it's pretty rosy. That's what I'd say. And I invite you know, banks to catch along, and some are actually. We don't give that enough credit either.
Yeah, that was the big thing too when we're talking about this title here, because a lot of you do work closely with banks. And Kevin, I think, you know, when we talked about staking services, one of the Arab Bank Switzerland also working with you guys there too. So I mean, banks work with a lot of these things, and you're right. I mean, viewpoints are changing rather quickly in terms of a lot of financial giants embracing crypto. So I don't know if you want to necessarily kill friends here, but Ben, when we're talking about other changing views, there's also regulation that's been changing too, and that's one that's, I mean, it changes very quickly. And stable coins have been catching a lot of the attention right now across the board from regulators. And that's interesting just because I feel like it's the easiest one for consumers out there weighing whether or not the opportunity is better in crypto to really compare to something that they might be getting at banks, because it's supposed to stay at $1. So you can compare directly the yields that you might get from a bank versus platforms in DeFi or like what you guys offer. But when it comes to regulation, I mean, how do you judge, I guess, how regulators are starting to look at what they should be doing about stable coins right now, and what you see as the future there?
I'm not sure if I can really judge too much about what regulators are doing, but maybe if I try to read the tea leaves, it seems like there's, of course, a lot of news hitting the headlines. And I think this kind of scrutiny, there's one aspect where I think it stokes a lot of concern. I think there's a lot of uncertainty in our space as a result. But I think there's also an aspect of cleaning house that I think can be beneficial long-term. Even actually when I look at short-term dynamics, I think some of the scrutiny and the questions that come to bear on stablecoins in particular, while some of it sounds like FUD and rumor mongering, it seems like it might also be a lead generator that we're literally hearing right now of institutions who, might not necessarily have a direct interest in investing in cryptocurrency, but they might want to express certain viewpoints on the future of certain stablecoins. And as kind of a gateway into participating in this space, if that's what it takes for them to start building their first relationships with a trading desk or similar, maybe there's some silver lining there.
Yeah, and Alex, I'm not sure if you want to weigh in too here, because I know you've had discussions with regulators before, and everyone has to deal with certain questions. When it comes to what we've heard from the SEC lately, it seems like investor protection is really what we've heard Gary Gensler, the head of the SEC, talking about in terms of why he's so worried about not just stablecoins, but everything going on in DeFi and crypto. And, I guess there's a question of what that means in investor protections. When it comes to how banks are regulated, of course, disclosures are there to maybe protect against what we saw happen in the financial crisis. So you can argue whether or not any of this stuff is ever good enough to protect against disaster. But when it comes to investor protections in crypto, I think a lot of people would agree it's good to maybe root out scams out there or anything that is fraud. But as you see it, I mean, what are maybe the right things to be addressing when it comes to investor protections and making sure that people's money on Celsius, on other networks, are actually protected?
Yeah, so there's a lot of touch points here. I think it's very hard for regulators to know who's a good actor and who's a bad actor, right? I mean, they're not experts in the space. So they're basically blowing the whistle and saying, let's stop the game, let's figure out who's who, and maybe we'll allow the game to resume under different circumstances, right? So currently, like you said, there is CFTC, there is SEC, there are states. Each one of them is asking different questions. In most cases, they're asking for information. They want to understand what's happening, and they're trying to take rules from 1940 and apply those rules to something that didn't even exist 5 years ago. So I think obviously there's a challenge across the board here in bridging this gap and educating regulators, lawmakers, and enforcement agencies into understanding why this is good for consumers, how consumers benefit, and what's the difference between offering it to accredited versus unaccredited investors and things like that. And the rest of the world is watching, right? The rest of the world is trying to follow the SEC or the CFTC. So a lot is at stake, and I think basically the more we, the community, right, we, the industry, get together and help educate or help bring together best practices, I think the faster we can get across this uncertainty and FUD and actually continue providing these services to the people actually looking for them, right? I mean, the solution is that you can earn 10, 20, 50 times more than your bank, And that's what baffling regulators. They don't understand. Okay, they're looking at the gap and they're saying, well, somebody is not telling the truth. Somebody is either overpaying or underpaying these customers, right? And the question is really, who is that? As an example, JP Morgan just reported their numbers, 22 billion in net income, and they're still paying 0.1%. So Jamie Dimon can pay the same percentage as Celsius pays. He just chooses every quarter to take all that profit and give it to his shareholders instead of giving it to his customers. And that's really what we're trying to communicate to regulators. And again, every 10 to 15 years, we have to bail out these banks, right? We, the people, have to borrow from the future, go and create more debt for our children, and use that money to bail out all the banks who took too much risk. So the current system is just not a viable system, right? Crypto went through two stress tests, flash crashes, May 2021, March 2020. The Fed didn't jump in and save us. We didn't need a bailout. We didn't need, the repo market to be reflated by this or that institution. So we've tested it out. It works just fine. And I think the Feds and others should just let us continue doing what we're doing instead of trying to make us look like an institution that is failing every 10 to 15 years.
Yeah, I think it's, I think we always, you said it so perfectly. It's like, the problems, the benefits going to the shareholders, not to the customers. Like these are all the bailouts. Like these are the problems we've always known, but we kind of swept under the rug, or it's like, yeah, well, what are you going to do about it? But it's not just that it's like viable. Now it's feasible. Like it's technologically possible, and we've gotten practice with it in our ways, and now we can apply it to other things that have been like haunting the traditional institutions, including finance, including financial regulation, including government of any kind. And it's like, look, this is actually to regulators. It's like, look, this is meant to make your job easier. It's not about like, it's not a threat. It's like the solution. That's why people created it and continue to create it. Like they're the people have maybe the same sentiment as the regulators, ethically and all of that. I mean, we have to have a functional society in which we all collectively agree on things to make things hum, whether or not we put that into a program or a constitution. It's a network, but also like it's not scary. It's the answer. It's the same people who believed in the same things you believe, but they just engineered something. So it's finding harmony between those two forces that ultimately will happen and has started to happen. And there is good, like, we also have to appreciate how good they're getting. I feel like there are forces in government that are really starting to understand this stuff. And it might come down to this congressperson or that particular, judge or whatever. It's like, okay, I got you. You get it. You get how it works. Just like with internet, it was the same thing. So I think we're also thinking about like a new generation that's coming in. And it's not even just about like, policing this thing. And I don't think it's the bad guy. I think people want regulation, just the right regulation, the ones that make sense. And when it comes to banks, even there's a whole new generation of young associates going to, investment banks now. And like banks never lost money by listening to what the young people are saying. So those executives can get some creative ideas and understanding the future ideas. And that young person who just happened to grow up in the crypto generation now starts to lead a team, take on independent initiatives. And there's a bunch of those in different bank branches all over the world, in different divisions all over the world. So, I think the transition is coming in a steep curve, and pretty soon we'll be talking about a very different scenario. Where there's more built off of like the kind of the coming together. And because we're ending the year now, I think we should look back into the beginning of the year and remember that the comptroller of the currency, just the office of the comptroller, put out general guidelines for banks to accept stablecoins as settlements. That happened. Like that's a huge move. We so quickly get like such high expectations. We forget the state of where we were a year ago. So like this is like a huge rapid moment. I think this is the most exciting time for anyone who's ever been interested in any of this stuff. It's like, oh, you're looking when it's going to get exciting to get in. Okay, right now is something to look at. You want to stay informed. When should you start reading up on this stuff? Yeah, now's a good time. Now it's getting really interesting. So there's a lot of movement to happen. And I think like the conversation is really starting. So we're getting to deeper and deeper levels with this. Visa had a partnership this year. They announced with USDC. That's a pretty big deal. And then we see all these mainstream artists go on oneof.com. A lot of the influencer types that we considered mainstream and part of the traditional world. It always starts with media. Media starts to cover it, and then you start to see the rapid follow through because in the product adoption curve. So like I think it's that's a pretty interesting thing. But yeah. So it's an exciting time ahead.
You're playing the greatest hits of 2021, the highlights so far, and there have been. I think it's pretty important.
Doom and gloom, though. I think it's a good thing. I mean, maybe I'm just like overly positive about what's been happening here, but I think the transition is great, and I think we should keep building on that because it's working, and everyone seems to be okay with the progress. Yeah, there's a lot of friction along the way. Who said it wasn't going to be? But that's happening. That's the good thing. That's the activity we want.
And oh yes, how could we forget El Salvador also adopting Bitcoin as legal tender? I mean, there's a lot of hits in 2021 here. And Ben, I mean, you kind of were in the remittances game with Abra for a long time here too. As you mentioned, maybe not in El Salvador or Latin America, but with Asia. I mean, there are real problems getting solved. There are real things happening. And well, there's a lot of, in crypto, I mean, the culture here, there's a lot of things that are kind of silly happening all the time. But there's real stuff in real life getting impacted here that does kind of get overlooked in terms of really trying to help. And I do wonder, I guess, kind of that back and forth between regulators and really focusing on what problems are getting solved, if it gets lost in the sauce, so to speak, in kind of the progress that crypto has been able to make in 2021, as Kevin highlighted.
Yeah, I think besides kind of the really attractive headlines, I think that we've garnered in the crypto space, not to mention maybe some of the more controversial ones, I think looking underneath the hood, you actually see quite a lot of demand from surprising places. And I think that goes to show that there, for a long time, there haven't been a lot of financial solutions for people outside of the developed world. They've oftentimes been beholden to banks of their own, or else restrictions in the domains that they exist. And so I think one thing that continues to surprise me when I look at our own stats is the proportion of representation from developing market countries. And I think, ease of use isn't just something that belongs to the US and Western Europe. I'd like to think that the work that we're doing to develop kind of probably the stuff that garners a lot less headlines is making a difference for individuals. And so if I had to trace the path from where we've come from, right, the Abra was initially developed to cater to C2C remittances to where we are today. While I think the nature of the usage case has changed a lot. A lot of people overtly want access to crypto. I would say a lot of the tools that we put in place to facilitate that have been very much kind of the kernel to make this stuff accessible. So I think the title of this chat was sort of killing banks, and I think in one way we're doing a lot to in fact partner with them. I think it's also partnering with other aspects of the legacy ecosystem to try to actually solve real world problems, to give users what they want.
Yeah, and what they want. Go ahead, Alex. It sounds like you want to jump in here. You know much better than I do about what consumers themselves want.
Yeah, to add to what Ben was saying, the people who are killing the small banks are the big banks. It's not the crypto world, right? I mean, small banks cannot make any money taking deposits and then giving it to the Fed, right? Large banks have other activities. They have SEC lending. They have all kind of other things that they do, derivatives and so on. And really what happened here is that the Fed had to lower rates to zero in order for us to basically reflate the economy, right? Get out of this COVID recession. And they had to print trillions of dollars to do that. And the main people who are suffering are retirees and small banks who cannot play in this business, right? So what you're gonna end up with are countries who have their own CBDCs or central bank digital currencies, like China and others. Like Nigeria just issued the e-naira just a few days ago, right? Replacing its fiat currency. And so you're gonna have that as one of the kind of like if you think about it as the car race, right? That's the first car that's already out of the gate, right? And we have Bitcoin, Ethereum kind of competing for the open standard of banking. And then the third option is going to be corporate stable coins and corporate solutions like JP Morgan and others are trying to create. So it's not clear just because the internet won the last race and we are all cheering for open source and open standards and we're all kind of supporting that, doesn't mean it's going to win this time. We may find out in 10 or 20 years that the digital yuan is the reserve currency of the world. And because all of us, we the people, did not adopt, did not support Bitcoin or Tezos or any other blockchain, we ended up with a solution that none of us really like, right? So we have to vote with our wallets in what is in our best interest, right? And if all of us around the world, just like we all voted for Voice over IP, and that's what we're using this chat right now for free. If we voted for AT&T, we would be paying probably $100 to do this video conference. So the solution is at hand. The future is here, right? But we need to leave the past behind, and we cannot migrate from one monopoly, which is the banking monopoly, to a government monopoly, right? That's what we really need to fight against.
Kevin, you're making eye glances there, so I don't know if that means you want to jump in here or not, but
no, I'm trying to like sort out in my mind between like I agree with that, I want that.
Yeah, there's a lot of there's a lot of
it's
nuanced
like, well, that part,
there.
but not that part.
Well, I think what's interesting here too, and we're talking about the global piece of this. We all know that central bank digital currencies are coming. But I mean, the Fed's been talking about it for the digital dollar and what that could do for kind of everything else here, and we've seen stable coins take off this year. We know that digital, Chinese yuan is going to come out too, and we know that there's the Olympics built around really getting it off the ground. There are, of course, a lot of questions in terms of national security to, I suppose, address there. But I don't want to get into that because that sounds less exciting. But when we talk about maybe some of the things here between DeFi and centralized crypto institutions, since we have both of you guys here, Kevin and Alex, one of the things that people talk about in terms of DeFi is, I guess, the clarity of knowing and seeing all the analytics out there. And we talk about potential risks. I don't know if that really matters to some people out there versus, traditional banking system. But it does seem like one point of nuance in terms of two different strategies to take on or kill banks right now.
Well, the transparency is definitely a whole new paradigm, right? So I think most people just don't have the tools to sift through all of that data and figure out, did this protocol pay out properly? Did the people get liquidated properly? Like today, you were talking about, I think Cream got creamed today for $100 million, right? So what happened there? Was that a rug pull? Was that a scam? Was that a flash loan, right? Again, most of the participants of that pool are not going to know what happened there, right? So what Celsius tried to do is really take all the information about our transaction, anonymize it, and then give it to you as a user of the platform, right? So you can, with zero knowledge proof, verify that if you are 1% of the Bitcoin pool, you earned 1% of the yield. That if you're 5% of the ETH pool, you earn 5% of the ETH, and you are treated equally to everybody else. And that's really what you want. You want the output, not PhD in data science with the ability to swim through the data lake and collect all that data and figure out if you're being treated equally. So So again, 1% of the population can do that, and there'll be the geeks swimming in all of the DeFi stuff, but the 99% is just looking for utility. They're basically looking to transition from the bank utility that abuses their rights, that charges them crazy fees, to a utility that acts in their best interest, right? And that's really what Celsius is trying to build, the future that Celsius is building for hundreds of millions of people.
I want to add, so here, all right, so I think of DeFi and everything that it is, the series of projects is one way of looking at it, of protocols, of a lot of little elements that we don't really necessarily consider part of the DeFi equation, but they are, as just a series of iterative motions, like it get like frictions being removed, certain things being automated. Like it's not really stoppable. It's just kind of, and it's not something that really can, you know, I'm careful how I say this. So, it's basically, it can't really be regulated. And if it can be regulated, it's very, very difficult to enforce. And so at least if the goal is to accomplish a task, whatever the task of, whatever the point of the regulation, whatever we're talking about is, certainly you don't want to make the problem worse. You can't just irritate the wound and expect it to get better, or the zit. Like there's a process here, and it's okay. You come to the table, figure out what this is, and how you can do a better job. So that's why I think so positively of it. But this is a resource. It's just open is a resource, and open does always win. There was a time when this kind of a conference, what you're watching, whoever's watching this right now, who probably feels the title was clickbait, there was a time when this was running on Flash, Adobe Flash, and that was the only way you could ever watch any video on the internet. And that was everything. There was a time when it was 98.7% of all video on the internet for years was powered by Adobe Flash. And then Apple was like, you know what? No, we're going to go with HTML5. And then it's like, oh, wow, how could he say that? Or wait, are they sticking up for open? Well, open wins ultimately. Again, eventually it's better for all actors to be within, some open world where, there is that element of self-regulation that we have to appreciate as well. Doing good on a citizen level. That's never been shunned by, I think, regulators. I think that's always been applauded. And that's why assembly is a good thing. And we're doing that with a new sense of digital commonwealth on Tezos. But I think that overall is the spirit of where crypto and DeFi is. So I don't think it's necessary to have what would be a centralized component in order to grant lawmakers and large conservative banks that sense of assurance. I think the technology can be the answer because it can be both the stable source of governance in as much as it is for the technology and for the data and the tamper-proof transactions and all of that, and more things to come.
It makes sense because, you're talking about what kills banks. And I guess to both of your guys' points, the optionality, the options of having these things basically opens the door. Bitcoin opened the door, and then everything else that came after it opened the door to kill banks because you have another option out there. It's kind of when we're talking about whether it's DeFi or what is being built out of more centralized lending institutions here in the crypto world is that there is another option, and there hadn't been for so many years. And so I guess, that optionality is one thing. This metaphor is tired now at this point, but a weapon here in the metaphor. But the optionality here, and to wrap up, I suppose, since you shot out the potential clickbait here, we do need to deliver on our title here, which is, of course, we said how, but I guess the major question here is when. And we've kind of documented a lot of progress here in 2021 as well. But if we were to kind of lay out your guys' timeline to wrap up here, when do you see banks dying?
Well, I think traditional banks, the banks that don't want to change, or the bad banks, I call them, it's still going to take 20 or 30 years, right? It's not going to be overnight. But I think you're going to find neobanks that are going to embrace all of these new rails, and they're going to provide very sophisticated solutions to their customers, and they're going to thrive, right? Because they have the same capabilities. To Kevin's point, they have the same open source access that we do or anyone else, right? So the question is, the competition is going to be over who delivers the most value to their customers, who treats their customers best. But this time, the fight is over all the money in the world, and the fight is global, right? I mean, the service we provide is consumed by over 200 different countries, people in 200 different countries. So it's a different fight. It's not about being a local bank in New Jersey trying to compete with, Chase or with JP Morgan or somebody else.
That's a good place to leave it. Since we're up against our hard stop time, I just had to add my name against murder there because, Kevin, you changed yours like 5 times during this, and I wanted to catch up and show I could do it too. But I'm also none of us here condone murder. That's just
how do we change our names to fast? I feel like I need to put some Abra branding in mine.
Oh, you got it on the top here. You had it the whole time. It all looked good. But no, thanks, guys, for coming on here to chat. I hope you guys enjoyed learning a little bit more about how lending and crypto aim to kill banks. Appreciate you guys watching here at the LA Blockchain Summit. Thanks again.
All right. Good meeting you. Take care, guys.